Hello everyone, and welcome to this session where we are going to be looking at what is going on in the US markets with particular reference to stocks, indices. Not sure if we've got time for some commodities, but we'll see how we hit on. And I have to apologize. I know it was slightly we started slightly later than we anticipated. We've had a few technical issues with our headsets, but they are now all resolved. So again, apologies, and thank you so much for taking your time to come and join us, as I said, for this session. It's early evening for us here in the UK. I don't know, I think I recognize some of our Forex program students, and those of you who come along regularly. I know, you're not all based in the UK. Some of you are over in North America and different parts of the world, but wherever you are, as I said, thank you for coming along to join us, and us being myself, Anna, and my husband David, who is sitting behind me. But before we start, can I just draw your attention to the disclaimer that I know you can see on your screen? As you know, trading can be a very risky business, so please, please, please don't ever think of using money that you cannot afford to lose. Right, if you came along last week, you will know that we looked at some charts with using the VPA concept of stopping volume. Well, today we're going to look at the opposite of stopping volume, which is topping volume. But before we do that, I just want to whiz through very quickly what is the state of play at the moment with the markets. Obviously, it's been quite an interesting period for the markets. This is just the NASDAQ that I've pulled up here from investing.com. This is today's price action, which is certainly very different to what we had yesterday. We've had some dramatic up days, dramatic down days, days when nothing very much seems to be happening. A bit of a down day today. It's down 99. I'll just have a look at some of the other indices that we follow. The US 30, the Dow Jones, that's actually positive. The S&P, it was down a bit more than it is at the moment. That's sort of trying to claw its way up. And I just want to have a quick look at the Russell before I come back to this tab on my browser, because the Russell 200 is the, as we say, it's the speculators index. It's where, as I always say, this is the index, small caps, quite volatile, and it's where investors try and find, identify the next Apple, the next big thing, as it were. So when markets aren't doing terribly well, you won't find money going into these more riskier assets, as it were. But it's always useful to keep an eye and see what's happening on the Russell 2000. But the reason for going back to looking at this tab from investing.com is we want to know what the VIX is up to. And the VIX is at 20, which is actually, it's a bit of a key level. I would say 20 to 25 is the kind, let's put it on the weekly, which is not quite so, there we are. This is the spike higher that we had when we had that the latest market swoon. It didn't get to 40. It only got to, where was it, 35. But 20 is now kind of a general consensus view that, if the markets are going to carry on higher into the Christmas holidays, then it is going to, either have to hold 20 or possibly, go back and look into the 17 and the 18th. And just in case you don't know, why do we look at the VIX? Why do we look at volatility, volatility indices? This is for the S&P 500, and essentially it's known as the fear index. So, and it works in an inverse way. So when the S&P 500 is moving higher, the VIX will move lower, and when when there is a major sell-off, and it's a very big sell-off, then the VIX will spike higher. There are volatility indices for the NASDAQ. You'll find volatility indices for practically every market that's out there, and you can find their details at the CB OE. We even have volatility indices charts for the currencies. For those of you who have taken our Forex program will know that that's included. The details are included in the program as well. And they basically give us an idea of whether the market is feeling stressed or whether the market is complacent. And complacency is an extremely dangerous state for a market, simply because the market will be moving higher, but the more complacent it becomes, then the greater the risk of a dramatic sell-off. And you will see this dramatic sell-off in the VIX. And if you go to the maximum, you can see here, we can go back to this was the famous one. This is our 2008, 2009, and you can see the high. It was 80, and then we had another one this was the pandemic, when it actually only got to a high of 50, which kind of told you that it was all a little bit sort of overdone. This is when, as there's fear on the streets, there's blood on the streets. That is the time to buy. When the VIX is low, it's time to go, and that is probably the time to cash out, as it were. So it's always very important to keep an eye out to what the VIX is actually doing, because the S&P 500 is like the benchmark index for general risk, if you like. The Nasdaq is much more, it reflects the tech the technology sector, the tech companies. If that is moving higher, then the market mood is positive. And the Dow, well, the Dow, there's only 30 stocks in the Dow. The Dow is a sort of the grand old lady of the indices, and with only 30 stocks, I suppose you could say it's more the value index. There's some really heavy hitters in there, but anyway, that's just a very general overview of the kind of information that you can glean by looking at this kind of data. And as I've mentioned before, investing.com, you will find a chart for practically everything that you're ever going to need, either as a trader or an investor, on investing.com. And there is a free version as well. Right, so we know what's been happening over the last couple of days. Next, really the market is now focused on what is happening next week, and next week is probably the last meaningful week, I would say, for traders, simply because we have holidays coming up, but it's where we have, well, we've got how many central banks do we have reporting next week? Well, we've got the Fed, we've got the FOMC, we've got the Swiss National Bank, we've got the ECB, and we've got the BOE. So it's, I think we're all going to get indigestion from all the fundamental data next week, but it should give traders and investors some kind of idea of, what these banks are planning, moving into 2022. After that, things really do tend to quieten down. But in terms of liquidity, things have already started to quieten down. And at this time of the year, what happens is, markets like to have what we call the Santa Claus rally. So we end the year on a nice, positive, upbeat note. But however, simultaneously to that, you will find liquidity is draining away. And the kind of market condition that creates, particularly for intraday traders, short-term traders, is that you do get more volatility, as expressed by spiking of prices, because, as I said, there isn't enough participation in the market. What David and I always tend to say is, trading opportunities will present themselves, but possibly, once you have some profit, then just take it, because things can reverse very, very quickly. And volatility, the drivers for volatility at the moment, obviously there is this reduction in liquidity. We still have the virus. That's part of the reason why we've had all this volatility recently. Obviously the new variant, it doesn't appear to have caused major problems in terms of severe illness and death, as it were. but the jury seems to be still out on that, and it may simply become, and if that doesn't come to pass, which please God it doesn't, then the markets will take the same view that it took about the Delta variant, and it will kind of push it to one side. But as I said, it's not, the jury's still out on that. So we still have that lurking in the background. But there is a third element, and I mentioned this at our Forex webinar yesterday, and that is the situation in China with Evergrande. And I believe today was the first time when it has gone into, and we've had an official default. I think the last time it had to make some bond payment, and it managed to find a few $1 million, that they'd lost behind the sofa, the cushions on the sofa, as it were. So those are the three sort of main drivers for volatility at the moment: low liquidity, what's happening with the virus, and we have China. I'm not sure in the US whether the debt ceiling is still a major issue. That may suddenly sort of pop up on the radar, but those are the three that I would say you really need to keep an eye on at the moment. And what's also interesting, which brings me to this headline here, and that is what is happening in the bond market. Because the bond market is really not behaving in the way it should do, and people are sort of scratching their heads and saying, what on earth is going on? Because obviously the major narrative for the central banks is what is inflation? I mean, we all know, and David and I have been banging on about inflation since June, David, May, June time, when we said it's all very well for the banks to have these very fancy metrics for what they are deemed to be inflation, but you and I know how much it's actually costing us in our in our pockets, as it were. Now, the bond market would normally sort of reflect, if there's inflation coming, then yields would go up, and etc., etc. But something very odd has been happening, and that is that the long-dated bonds, the 30-year bonds, the yield, as you can see here, is actually going down. Now, that's not supposed to happen, because the way the bond market functions is if you lend, it's the same as if you lend money to someone, and over a longer period of time, you're taking more risk. So obviously your yield should, the interest you're going to charge on that should actually reflect that. Now, we'll talk about the debt limit. That's suddenly come up as well here. And very eminent analysts on the bond market thinking, well, maybe maybe the central banks are right. Maybe inflation is transitory, etc., etc. But there is a much simpler explanation for the yield going down, and that is the demand for bonds is, I wouldn't say it's an all-time high, but the numbers are extraordinarily high from banks. What treasuries are known as? They're high quality liquid assets. And so people park their money in bonds because they're perceived to be sort of safer than stocks. And that also tells you, so if loads of money is flooding into bonds, that can also tell you what the general market mood, market sentiment is, particularly if you're going into these longer term bonds, because even at these ridiculously low level for a 30-year bond, as I said, and this is even less than the last issuance. Clearly, they're not very positive about what what's coming down the line in terms of the stock market. When traders and investors are confident, they will go into riskier assets. When they're not confident, they will withdraw from those risky assets, and they will go into safe havens, for want of it. But you want to go into the right kind of safe haven, because you want to go into an asset that is easily convertible, that then there's also going to be a market for, and that's why these high quality That's why treasuries are considered high quality liquid assets. There's also mortgage-backed securities are also perceived to be of high quality. So the bond market is not, as I said, the inflation narrative is not really reflecting the concerns that, you know, if you remember a few weeks ago, you know, the market was having a bit of a meltdown about inflation, because high inflation isn't conducive to higher stock prices, particularly for those sectors such as technology, you know, the growth sectors, because it's the cost of money. You know, if you've got a growth company, you've got a Tesla, you've got a you know, you're a company that is on the tech side, and you want to develop, and you want to sort of you know, you're still on the road to you know, you are established, but you're not, I don't know, you're not sort of 10, 15 years down your development as a company, then you're going to have to borrow money to expand, and it's the cost of that money. And when inflation rises, the cost of money rises, although in this case it doesn't look like it's happening, because of the bond market sets the cost of money. It's, you know, your plans are you know, you're going to have to review your plans, which is why there's always a sort of tech sell-off when there are inflation fears. Now, everything I'm saying that I say in these webinars, I've mentioned it before, but I'll just mention it again. David and I are putting together a very comprehensive stock program in which will incorporate how we approach the chart analysis based on volume price analysis. But we feel that whether you're a trader or whether you're an investor, there's all this stuff, if you like, that you have to know, and there is, I can't tell you how much it is. There is a lot of direct information. You obviously have to understand the fundamental news, but you also have to understand the related markets. This is very much, it's a similar structure to what we have done with the Forex market, and we call it the related markets because these markets are all interrelated. So what is happening in the bond market, what is happening in the commodity market, what is happening in the Forex market has a direct impact on the stock market and vice versa. So what is happening in equities will also impact the other markets. So they all interrelated. They you know, they have direct relationships, they have indirect relationships, and there are also relationships within the individual markets themselves. Now, the stock market is fascinating. It really is fascinating, and there's a lot of stuff out there which what we're trying to do is put it into a format that is easy to digest. That's the first thing, easy to understand. And more importantly, a lot of the data, a lot of the information you need, some of it is you have to pay for. So what we're trying to do is trying to put as much together as we can that is actually freely available in this program, and you know, find a way around not having to, you don't need a Bloomberg terminal, you don't have to have a subscription to Reuters, as it were, but you have to know all these, you know, all these things, if you like, all these factors that will have an impact on stocks. And that doesn't matter whether you're only day trading stocks or whether you're looking to hold for a medium term or even you're looking to invest. And I have to say, it's been fascinating. It's a lot of work. It's been fascinating. And I think by the time we put it all together, I think we'll certainly be very proud of it. And I hope traders and investors out there will also enjoy it as well and make use of it. Right. So that's what I wanted to say on that very quickly. This is one of my other calendars that I use. I actually subscribe to Financial Juice, but there is a free version, but it's not live. It's very slightly delayed. And the nice thing about it, I like it, is you can go in and you can bring up the individual categories. There's a crypto, there's equities, there's the Forex, as I said, there's risk. We know the guy who put this together actually, and he's a great guy, and this has been his baby for some time now, and it's taken him a long time to put this together, and I think it's excellent, because you do get the feed which you can then tailor to what you actually need. But it's very useful for learning. So you may not understand, you know, the terminology, but it's just like everything else. If you can expose yourself to all this information, and then gradually you will begin to understand it. You can always sort of Google, you know, well, what does it mean? I don't know, what's the Fed reverse repo operation? That's something we're actually going to cover, because that's actually quite important, not only in the Forex, you know, Forex, but for stocks as well. But I'm not going to go into what the Fed reverse repo is at the moment, but rest assured it will be covered in the program. Right. I just want to stop there, move this over here. And what I want to do is, as I said last week, we looked at stopping volume, and it was stopping volume in the sense that it obviously happens at the end of a move lower. And the way I did a search, but I didn't search on stopping volume. But what we do is I have, as I said, those of you who come regularly will have seen this, is it was using FinViz, where basically I have a very simple parameter of searching for stocks over 1 million, have a relative volume of over 1.5. And what it threw up was a huge number of stocks with massive amount of volume going in. I mean, I'm talking, you know, this is 33 million. It's not quite so dramatic this week, but I'm talking 20 million, 18 million. I've got them here. 19 million, 60 million. 60 million went into Carnival, which is the cruise liner people, and I thought, oh my goodness, you know, they stood out. And then by looking at when I looked at the charts, they were all at, you know, they'd all had this big fall, and then this massive amount of volume came in, and that told us that, hey, this is what we mean by stopping volume. And it was finding looking at some charts to see how did that actually display on the chart itself. And the one we talked about last week, we ran out of time, so we only focused on this is Bristol Myers Squibb, which is a pharmaceutical company, and this was the piece of price action that we saw. As we saw here, this was the actual amount, and I think you can see it's about 25 million. And what you want to see with stopping volume, as we can see here, is you want to see this anomaly, you want to see this massive amount of volume, and then you compare that with, well, how does that work with the candle? And what we see here is a relatively narrow. We see a bit of a wick to the bottom of the candle, but it's a narrow spread candle. That is a clear anomaly, because if you look at the previous candle, you can see that's quite a wide range candle with a lot of volume underneath it. There was also a gap down. So a lot of traders who don't really understand gaps would say, oh great, you know, there's a big candle, biggish candle, and if they use volume, great, there's a lot of volume and a lot of selling in there, and a gap down, you would think your natural reaction would be, oh great, this is gonna collapse out of sight. But it doesn't. What it does, you get even more volume coming in, and you get a smaller candle. And in fact, it's quite surprisingly, it did actually, not quite a V-shaped reversal, but we have had a reversal. Now on my site, which I have here very quickly at annacouling.com, you can catch up on, because subsequent to that, we did a post about it. There we are on stopping volume. Here we are. Now this is the screenshot that we took at the time of this was done on the 6th of December. This is what this explained the stopping volume. It's an annotated, it's exactly the same chart that you see there. And what we looked at, we said, well, this is all very nice. There's not lots of buying volume coming in. That's great. But the question you really want to know is, well, yeah, that's great. Well, where's it going this time around based on all this buying that's coming? And what we said was, well, what have we got here? We're back to the volume point of control, and what we can expect is congestion, because as part of volume price analysis, it is volume, it is price action, but I can't stress too much the importance of understanding support and resistance. And that is support and resistance, not just price-based support and resistance, but volume-based support and resistance. And that is what the volume point of control is. It is volume and price over time. And what you get is you get this lovely histogram, and the volume point of control itself is that point on the chart that is where, if you like, there is no clear bias one way. There's lots of transacted volume. Price will then attempt to break away one way or another, but until there is there's some kind of catalyst or some sort of reason, or you have to have a huge injection of volume to actually drive the price in one way or another. You can see here we had a kind of we had a fake out there. It actually hit the price-based resistance that we have. This is how we measure support and resistance on the NinjaTrader platform, and it's a similar one on the TradeStation. Is we have an indicator called the accumulation and distribution indicator, and the beauty of this indicator, as you can see, you have these little hatch lines, is every time price touches a level, as we can see here, but fails, the line gets thicker. So not only do you have a line, if you just drew this on the chart and just drew it straight across, you would have a support and resistance line, but you have no idea whether it's a strong line, it's a weak line. Whereas with this indicator, it tells you immediately this is a strong resistance level. And similarly, when it's at the bottom and you've got here it's in blue, if it's thicker, it's a good solid support line. So if price comes down to test it, which it did here, and whether it's sort of coming back here, it is likely to hold, as it were. And each time it's tested, the line gets thicker. So if it's got to go through, it's going to have to need more volume, basically. And we said this is where it's going to, and it has. It's actually stopped. It's at 57. But also part of volume price analysis and part of all technical analysis and trading is we look at multiple time frames. And when we look at the weekly chart, you think, okay, well, it's got to the volume point of control there. $60 seems to be, if it manages to get through on the daily chart, where is it going to go? It's got, the chances are it's going to be heading for $60. And if you see here on $60, what do you see? You see some very, very thick lines that have acted both support and resistance. So you've got this really strong cluster. So if it manages to get to 60, great. And on the weekly chart, we've actually got a really nice example of the price action coming off a hammer candle and reversing, which is actually quite unusual, but it does happen. And if we go even further and go up to the monthly chart, just before I do this and refresh the historical data, this is what it would look like if you just had these lines, and if they weren't sort of thick or thicker because of the time they'd been tested, you have no idea whether they're good, bad, or indifferent, as it were. I'm just going to refresh the data, historical data, and hopefully the VPOC will come up. There we are. Yes, $60 is clearly a very, very important level. Now, it's the VPOC is at the monthly chart, but we saw on the weekly it has this very, very strong resistance at the weekly. So the stopping volume was great, fantastic, gone up here, but this one's got a bit of a struggle to go to carry on. Now, the one we didn't feature last week, we didn't have time, was Carnival. And again, you can see here there has been huge injections of volume. That's a sort of a hammer candle. Forget what happened subsequent to that, but you had this big gap down. You've got this hammer candle, a ton of, this is 85 million. This is phenomenal. And what happened? Well, it did go up, then it came back down again, and in fact, it had another thump down, because obviously this is very much a stock that is going to be affected by what happens with the virus. Any travel, if they're going to be bans, if they're going to be also, you know, you can count them on the finger of your hand. Airlines, cruise liners, etc., etc. It doesn't take a genius to figure that out. Then we had this big candle. And you say, well, okay, there's a big candle, lots of volume underneath it, but it didn't go down any further. And this is where, as I said, you also have to read it in conjunction with support and resistance. And this is where the volume support came in. And in fact, the next day, there's almost as much volume and up it went. So this was the initial signal for the first stopping volume, but it didn't happen straight away. And the analogy we always use is the tanker analogy, in the sense that, you know, this is the first, you know, this is when the brakes come on. But if you've got, you know, this is a cruise liner, so the same would apply. Before it can turn around, it is not going to happen in you know, in one candle or even two candles, unlike you know, the previous chart that we saw. But this has to be buying in here, because otherwise the price would just keep on falling, and the volume support will also help. And as you can see, the amount of, you know, the amount of volume that's coming in, it's at, you know, it's gone down to 1650. I don't know what this was at, what the height of this, you know, what this stock was at the at its height. But you know, there'd be plenty of people out there who consider this to be a very cheap stock, and you know, and cruising will come back at some point. So off it goes, and this is where it's heading. So I didn't have time to go through this one, because this was a, if you like, this was one where there was a lot of stopping volume coming in, but it didn't happen straight away. Now, very quickly, before I pass over to David, topping a volume, I've got two examples. I'm going to go back to my site here, because it actually, we followed it through, because topping volume happens obviously at the top of a trend. And this was stopping volume, example of topping volume. Here we are. And I've got two examples. I've got CF Industries. And what we're looking for, again, what we're looking for all the time are anomalies. So we are looking for, you know, where it just doesn't make sense. You know, you see a massive volume come in, and the candle, you know, you think, hey, that's just doesn't look right. And the wonderful thing about volume price analysis is, once you spot these anomalies, you'll see them all over the place. It doesn't really matter that this happens to be CF. This could be a Forex pair. This could be a bond. This could be a commodity. It doesn't matter. And they repeat. And they also occur in different time frames. So if you're an intraday trader and you are on the faster time frames, and you know, you have a nice move higher, and suddenly this happens, you see this come in with a relatively narrow spread candle, and what do you see? Effort and result are in disagreement. This violates one of Wyckoff's very important laws. Richard Wyckoff had 3 laws. This is the law of effort and result, and your expectation is that the chances are this will then reverse. So if we go and have a look and see, this was on the 6th of December. Let's see what CF have been up to. There we are. Let's have a look. And once again, it was back down to the volume point of control. As I said, the volume point of control, as well as being this very important zone on the chart, it of itself will then act as a support and resistance as well. And once it got here, it did go through, but you know, it's gone back to hug it, as it were. So we're having a period of congestion, but we had, you know, this move lower, and we had, as I said, but the first signal that this was going to likely to reverse from this run higher, and you can see the run higher, you know, fulfilled all our criteria for volume price analysis. We have rising prices, we've got wicks to the bottom of the candles, and we've got rising volume. Then we have one candle where we do have weakness to the top. Why it's weak? Because we have a wick to the top of the candle. And then this is the candle which really kind of says, that looks a little bit suspicious, as it were. So, you know, and we run into volume resistance. That is, the volume resistance and support is derived from the volume point of control. It's actually part of the same indicator. But just to give you an idea of how this, you can also see this. This is probably a slightly, not a better example. This is more what you would, you know, certainly look out for. Now, this was on the Euro Aussie. This is the hourly chart. And what we have here is we have this very strong move higher on these candles, on these blue candles, volatile candles. Why they're volatile candles? Well, we have an indicator which fires off in real time, these little purple arrows, and it's because the price action is outside of the true range. Now, what tends to happen is once that completes, the price action will go back into the spread of the candle, which it does. But look at the volume underneath it. I mean, it's just, I mean, it started off here, actually. We've got this candle here, which is like a little hammer on this little pullback. We can see the buying coming in. Then we have volatility is also momentum. And look at these, you know, these bars down here. Then we have another volatility candle, which is slightly a bigger range than this one, and as much volume going into there as well. We have a kind of retrace. It carries on higher, but this is really the candle which is of most interest, because these are moving higher. Yes, the volume is falling away, but not dramatically, based on this little candle here. Very narrow body, wick to the top, wick to the bottom, on high volume. That is a really, really strong signal. And if you just, you know, I know we look at hammers, and I know we look at shooting stars, but sometimes these little candles like this, compressed price action with lots of volume underneath it, sometimes they're more powerful. And in fact, the Euro Aussie has been on a you know, quite a dramatic move lower. But that is what you should be looking for. So those are the two examples I wanted to show you on topping a volume. Just have a quick look on the weeks, just to, because I haven't, there we are, just let's see here. There we are. Where's this got? This has probably got a little further to go, in the sense that, you know, where is the, we've got the support, we've got volume support here, and then we've got the VPOT down there on the monthly, on the weekly, and on the monthly. Well, the monthly is even more dramatic. You have these big long wicks to the tops of the candle. We've got some support here on the accumulation and distribution, and it's a fair old way to fall on the monthly. But as I said, I think two really nice example of topping volume. Right. One other thing I just wanted to highlight for you, and that is, I know I've mentioned them before, but we've not really looked at them recently, and that is Stock Beep. Stock Beep is a fantastic resource, because with the kind of year coming to an end now, and this is just, you know, maybe some homework for you, if you like. If you, hopefully you will have my, you know, copies of my books that are up on Amazon, which explain the concepts of VPA. But it's nice to see, you know, to look at charts and just study them and look at a chart, look at the volume, then look at the candle above and think, oh, is that telling me something? What's it telling me? Is that, you know, is that as it should be? Is it, or is it violating, you know, the law of effort and result? And the guys, I don't know who they are at Stock Beep, have actually made some very nice improvements. They've added extra features to Stock Beep. This is absolutely free. It's they only deal with, I think, 1,000 stocks, but that's honestly, trust me, that's more than enough. But I mean, just, I don't know, let's just choose one completely out of the blue. You can search on new highs, new lows, breakout, breakdown, high relative volume, gap up, gap down. I've actually gone, they've even got a VWAP one. I've just gone down on high relative volume. I mean, this is, you know, they give it a value 4.5. That's quite high. But if you go onto it and click it, it actually pulls up a really nice chart. And if you go to year to date, you can see, I mean, this looks like a classic sort of pump and dumps a chart. Anyway, a stock anyway, but this was the one, Lucid. Now Lucid is really interesting because this is an electrical vehicle manufacturer, and it's actually been in the news at the moment because they have they've just sold off a whole load of what they call convertible notes, isn't it, David? It's like they've issued a bond and it's been really, really heavily subscribed. And then at the same time, they're also being investigated by the SEC. And for next year, certainly anything to do with green technology, electrical vehicles, and this has nothing to do with electrical vehicles, but certainly the biotech industry is, they're pretty much, those are the two sectors that I think are going to be coming to the fore. But this is Lucid. And again, we had a sort of, we've got a sort of a distribution up here. Look at the volume under the upcap. This is in an uptrend, clearly. You're down at 55. Are there wicks to the tops of the candle? What's happening? You know, we've got some dojis. What's happening to the, you know, what's happening under the green candles? You know, is the volume, you know, reducing under the green candle? What is this chart telling you? This is even before you have put the support and resistance. And I just think it's a great way for you to learn the concepts of volume price analysis. And I said Stock Beat, they've got these really pretty charts, very easy to understand, very easy to look at. You know, go back and look and say, oh, right, oh, that's a lot of volume there. Then it will help you with your benchmarking because you've got that volume bar, you've got that candle with that amount of volume underneath it. Then you come to this one and you think, oh, okay, well, that's quite a wide spread. That's quite a wide spread. And yet the volume is much less. What is that telling you? That is what you're looking for all the time. Right. If you've got any questions, just pop them into the chat box. I hope that all made sense to you. Can I pass over to you now, David? That's it. I'll pass back to David. He's got, I don't know what he's looking at. I asked him to, I think I asked you to have a look at Apple. I thought Apple looked very interesting in terms of, I'm not saying there's topping volume on Apple. I'm not saying that at all. But it, I think I got on FinViz, it came up with 50 million earlier. But I looked at the candle and it did look a bit anomalous. But I'll leave David to explain that to you.
Wonderful. Hi, everyone. Good to see you. Oh God, sorry. Show my screen. There we go. Getting ahead of myself. Can you see my screen? Yeah, great. Okay. Hopefully you can hear me as well. Just move the chat box out of the way. Get that down there. There we go. I always do what I'm told by Anna. So I'm on Tesla at the moment, but I have Apple on TradeStation over here, somewhere or the other. Let me just find Apple. There we go, I got Apple there. So I'll come over to that in a minute. But I just wanted to start with Tesla. In fact, yeah, let's start with Tesla because there's a really nice move. Now, what's interesting about Tesla is that certainly for intraday trading, you can almost be guaranteed that it will deliver in some way, shape, or form. And the point I wanted to make about today is even in, and let's just open the daily chart just to make it a little bit easier on the eye. This was the big volatility candle that we had a few weeks ago, which we wrote some analysis about, and we said at the time that what we're going to see and expect to see, because a volatility trigger on a daily chart is important, it's significant. They don't happen that often, but when they do occur, you need to pay attention, because remember that what happens on a daily chart has greater weight than something that happens on a 4-hour chart, and a 4-hour chart carries more weight than a 1-hour chart, and so on down the chain. So the greater the time period, in other words, the slower the time period, the greater the weight. I mean, if we get one on a weekly chart, it's even more significant, and a monthly chart is very rare, but they do happen very occasionally. Whenever you get one, then what you're looking for is one of two things. You're either looking for a full-blown reversal, or you're looking for congestion, and we suggested that we would see congestion, which is what we've seen for the last few weeks with Tesla, which, let's be honest, you know, after this dramatic rally from, where are we, $700 right the way up to $1,200, $1,250, we did raise a few eyebrows by saying that, because generally speaking, Tesla is expected to whiz around all over the place, driven by a whole raft of forces. But that's what we're seeing at the moment. So even in what is considered to be a relatively benign phase of price action, there are still plenty of trading opportunities. And I just wanted to flick up the 2-minute just to start with, because this really encapsulates intraday trading, not necessarily just on stocks. This could be anything, and it's the beauty of VPA and really any trading. Once you understand price action, once you are familiar with indicators, once you understand volume price analysis, then you can apply that to any chart. The fact this says Tesla up here is almost irrelevant. It could be a currency future, could be an ETF, could be a stock, could be a spot Forex contract, could be anything you care to name. It really doesn't matter, because the principles are the same. And the principle here is one of patience. We had this nice period of congestion, obviously on a 2-minute chart. You know, the nice thing with NinjaTrader is that it actually prints your local time. So this was 1640 our time right the way through to 1740, 1750, so hour and a quarter or so of sitting there and waiting, being patient and waiting for a break of some meaningful momentum to it. And in addition, what you'll also find, and again, we've highlighted this a lot over the months and years, is that when you get the price action rotating and oscillating around the volume point of control, which is the yellow line, which is the fulcrum of the market, it's the point at which you can think of it as a seesaw. Two people of equal weight are on the seesaw. It doesn't move a great deal. As soon as one gets off and someone heavier or lighter gets on the other side, it will move. And it's exactly the same principle here. When you're trading, or when the price action is around the volume point of control, then it is at price is in agreement. It's reached a point where there is no bias to one side or the other. There's no bullish bias. There's no bias to the bearish side either. The two components of the tug of war, if you will, are in agreement, and that's where it rests, and that's why the volume is the greatest at that point over here. What happens thereafter is that as a result of that congestion phase building, you also get these price levels building. This is the accumulation distribution indicator, which Anna highlighted. We've got one above and we've got this one below. It presents this visually for you. It tells you instantly, you don't need to know anything else to understand that these two regions are the strongest on the chart. Yes, we have another level up here, but that's not so strong. And we have these minor levels down here, which are relatively faint. And that means they are far less strong. They've probably only been tested once, maybe twice. But these guys here are very strong indeed, because they've been tested multiple times. They've held. And obviously, when price moves through one or the other, what was support becomes resistance, and vice versa. So when you're trading a breakaway strategy, a tactic like this, the only thing you require, and it is the only thing you require, is patience. And once you are able to apply patience to the move, it opens a lot of opportunities, because the price action above is very well defined. The floors and ceilings are very well defined. And therefore, in creating that definition, it gives you very clear areas to place your stop loss. You know, if you're trading this short, if you're taking a short position, then any stop loss above this level here has got a huge amount of protection. It's got the price itself, it's got the volume point of control, slap bang in the middle. It's got a very strong level here and another strong level here. So you have 3 or 4. You've got volume-based resistance in terms of the VPOC, all this region here, and you have the more specific price-based resistance here and here, significant. So once you jump into this move, it's fairly obvious where you're going to place your stop, assuming it fulfills your money management rules. It's going to be above this level somewhere. So you've got all this in here, which is acting as a buffer in case you get a reversal against. Thereafter, what you're looking at is really confirmation with volume of the breakaway. On this occasion, we got a ton of volume comes in. Yes, we got a volatility trigger thereafter. But what are you expecting? You're expecting one of two things, either a reversal or you're expecting congestion. We get congestion and then we get continuation. And what's interesting in the continuation candle, which is also associated with high volume, but not so much volume. And when you look at this from a benchmarking perspective, if you compare this candle with this candle, they're almost identical. But what's curious is that the volume here is not, it is roughly, say half, but it's getting on that way. So what is that telling you? Well, it's telling you that, you know, the selling pressure that was under here has halved in moving to this level. And that's not to say this move isn't coming to an end, but it's certainly a warning sign to be more careful, because all things being equal, the volume under this candle here should be pretty similar to the volume under here, and it isn't. So the selling pressure is diminishing, and you can see it to an extent here. You can see that, you know, just by eyeballing it, we're falling from the tops, we're going down here. You know, the volume under the selling candles is falling away. So is this going to continue? Well, it's not going to develop into a price waterfall right now because the volume is diminishing, and what you want to see is you actually want to see the inverse of that. You want to see volume rising, not volume falling. So we're moving into another congestion phase. Now, that's not to say this is not going to continue. You've just got to wait and be patient and look at levels. And ultimately, you know, if this extends into another region like this, for example, you'll get some more development of potentially support and resistance areas. Maybe even the VPOC will drop down here. But for that to happen, this volume here has to exceed this volume over here. So it will have to congest at this point for some considerable time. But nevertheless, it's just a very simple example of the beauty of trading a breakaway tactic, in that it defines the areas of the chart very clearly for you, and it gives you those very clear areas to lay out your money management, to lay out your stop loss position, and it's really all defined for you. And as I say, the only thing you need is patience. Now we've dropped down to the 1 minute time frame, because we want to look at different time frames. We want to see what's going on as an intraday trader. That's what we want to see and do. What's happening here is we've got the volume point of control. We've got a very strong area of resistance up here. So that acted in that little reversal there. And it's the beauty of trading multiple time frames, because you're not just focused on one chart. You're going to be looking across this the whole time. The market reversed, it hit that level there, which was very strong, pretty much the same strength as over on the 2 minute chart. And then we had a little price waterfall. That's what we want to see. This is precisely what we want to see. We want to see widening spreads. The spread here is relatively narrow, then it widens and it widens again, and the volume has risen accordingly. That is a classic price waterfall. And obviously you want to see that going on over several bars, but what tends to happen, of course, is that you'll see the price waterfall developing. You will then get a little bit of buying coming in, maybe a little bit of stopping volume. The market will try to rally. Maybe you'll see some weakness come into it. You know, the market will try to rally, and you'll see a deep wick to the upper body of the candle with good volume to it. And then the continuation of that particular waterfall will continue, and then you'll see another sweep through. Obviously on here as well, we've got the trend monitor. The trend monitor is helping to keep us in. We've got it on the 1 minute, we've got it on the 2 minutes, and we've got it on the 3 minute, beg your pardon. So they are all, the trend monitor is telling you the same thing in all time frames. The reason that you've got a little bit of color divergence here, we've gone into the darker red, we've come out again into bright red, gone back into dark red again, is because we've got some congestion building. Now, if this is actually going to convert into or revert to a rally, then this will ultimately go through to a darker blue and possibly into a bright blue. It may go to dark blue or it may skip straight through into bright blue. We haven't seen any change whatsoever on the 2-minute, which is what we would expect, and certainly nothing down on 3-minute. But if this does change to a bullish rally, then obviously the first place you see it is here. It ripples through into the 2-minute and ultimately down onto the 3-minute and so on, and however many, you're not going to see any change on the daily clearly, but it will go down onto the 4-minute, 5-minute, 10, 15, however far out you're trading. We're now looking at the next leg developing. Let's just hop back into our 2-minute time frame. Just keep an eye on that 1 minute. Actually, I'll leave it there for a minute so we've got all of them up to see what's going on. Obviously, what we're looking for is volume to come in and confirm what's going on here. Are we seeing any buying coming in? Not a huge amount of volume under that particular candle. So, it doesn't look as though it's particularly strong in terms of the downtrend. We've got a level come in here, price-based resistance level coming into play just above our VPOC there. What have we got on the 2-minute? Well, we've got a kind of doji candle there, a little bit of indecision. We've got a pivot up here, so that's pressing down, giving us some more encouragement, if you will. As I say, no change on the trend monitor. Really want to see this break below the bottom of that wick on that candle and close with a nice flat bottom. That'll give us some encouragement that we're going on the next leg down. Don't want to see any wicks. Got another pivot on those three, so that's nice. Pivot to the upsides, what we want to see if we're shorting this right now. Okay, now we're dropping away. See what we get. We don't want to see it too fast, otherwise we'll get volatility again. Okay, that's down to 18. Nice. Okay, nice candle on there, no wicks. Nice, good volume. Nothing to frighten the horses there. This is basically the dialogue you would have when you're trading intraday. And this, as I say, this happens to be Tesla, but it could be anything. Let's just have a look and see what's going on in terms of the indices themselves. Come back to this in a minute. Where are we? Let's go to the multiples. There we are. Last time I looked, the YM was up and the NQ was down and ES was down, pretty much the same. So again, some divergence. The YM is trying to continue the Santa Claus rally. The NQ's come off a bit today, but then it's no great surprise because we're back at the volume point of control on the daily chart. So, it's no big surprise. What's also gives that away a little bit is also the fact that you've got falling volume here. So we've had 3 up days, but the volume is falling away. So the interest to the upside is falling away. It's not driving through. And as I said, when you're looking at a downtrend, you want to see rising volume. When you're looking at an uptrend, you want to see rising volume. Because whether you're falling or rising, it takes effort. So whichever way you cut it, you want to see rising volume supporting that particular move, whether it's to the upside or the downside. And what we're seeing here is falling volume. What's also significant on this chart is the actual volume associated with this candle. Anna mentioned benchmarking, and it is one of the key aspects of a volume price analysis because you have to get a sense of what you're looking at in comparison to what you might expect. And that's where you go to benchmarking because you are constantly comparing. And remember, this has got to be within a session. You cannot look at one session and compare it with a completely different session. It's more relevant perhaps in the Forex world, particularly in the spot Forex world, where you're looking at an Asian session, you're trying to compare volume with a London session. It's irrelevant. You're comparing apples and bananas. You have to compare it within the same time frame, and equally, you cannot compare volume on the cash markets when you're trading indices if you're looking at it against Globex as the indicator, because on Globex you're trading electronic alone, and in cash markets you're trading cash and electronic, so the volumes are huge when compared to Globex when it's trading on its own. So provided you accept that rule and you compare like with like, you're comparing apples with apples. This is a daily chart, so we're comparing apples with apples, but also remember in the back of your mind, there are high days and holidays, and we've just had the US holiday. So always remember that days like that, or half holidays, whatever they may be, or we're running into Christmas holidays now, or run up to Christmas holidays. You know, you've always got to bear that in the back of your mind that, you know, what is I'm looking at in terms of volume? Are there other external factors which can affect it? But when you look at this particular candle and you look at the volume associated with it, it is out of whack. It is not in balance, because you only have to look at this volume profile and just compare any of these other volume candles along here. I mean, you can just eyeball. The volume under there is, let's call it average, maybe slightly above average, but not much more. Now, is that enough volume to create that amount of price action? And the short answer is no, it's anomalous. And it's all to do with effort and result. It's Wyckoff's third law, effort and result. Basically, if you put that much effort in, what should you expect in terms of result? And what you've got going in here is insufficient effort for this amount of result. What the volume should be under this particular candle, if it was a genuine move, it should be, I would suggest, just looking at the eyeballing across here, it should be at least above, it should be the highest. I mean, let's face it, this is the widest spread candle on this particular time frame. So why isn't the volume up here somewhere and up here? So it should be much, much higher. It should be probably maybe double what you've got here, and it isn't. So it just gives you, again, you know, looking at the daily chart gives you an awful lot of information. You look at the daily chart here, you see this candle here. This is perhaps the highest volume on the chart. We've got more here. But you look at this, is this strong or weak? You've got a ton of volume going in there. You've got a wick to the upper body, and it hardly looks strong. It's not a great sign of strength, and we had this move to the downside. So just remember, benchmarking is extremely important when you're looking at whatever time frame you're looking at. You know, benchmarking is absolutely one of the fundamental principles. So what we've got at the moment is, as I say, we've got divergence. We've got the YM trying to rally. The NQ is a bit negative at the moment down on there, and the ES is kind of going sideways, sort of candle like it had yesterday. Let's just head over onto the multiple time frames and just pick that up. I'm not quite sure which index I've got on here. And if you are trading indices, just a couple of things to note. First of all, always have all three up, because it will give you information that you might otherwise miss. And secondly, I haven't mentioned it for a long time, but I should do. You don't have to trade the full the full-blown indices. For example, the YM, you've got the E minis, you've got the Dow mini, which is $5 a pound. You've got the big Dow, which is $25 a point. But in the last, I think it was in the last 2 or 3 years, and they are hugely popular. There are the micros. They are the 10th contract size, exactly the same, and they are very liquid. The common problem with micro contracts, and it's certainly true with regard to the currency futures contracts, the E-mini micro, E-mini futures contracts, the mini micro ones, they are a little bit illiquid, and it's certainly true of gold. With MGC contract, you would not see smooth price action like this, but that is not true of the index micro contracts. They are hugely liquid. They are extremely popular. There's massive take up in them by traders. And as I say, it's a 10th of contract size. So if you want to get into trading index futures, start with the micros. Don't start with the E-minis, because they are, as I say, a much higher value. It's where we started 20 odd years ago, trading futures through the Liffey, which sadly is no longer. So it was a great place. That's where we started trading index futures on the FTSE 100 at I think it was £10 a point from memory, which was you know, a decent amount of money 20 odd years ago. So that's where we are at the moment. So this is on the NQ. You know, no great price action at the moment to speak of. It's drifting lower, small rallies. You know, you look at the volume on the little rallies that are coming and going. You know, is it meaningful? How far is it going to go? You know, if I was going to trade that, well, you know, if you're going to trade down here and coming up here, how far is it going to go? It's going to go back to the volume point of control. Expect congestion. Why am I going to expect congestion? I expect it to go through this low volume node quite easily, but it's going to run into some trouble here at the volume point of control, because that's what you expect to see. That's what the volume point of control tells you all the time. Plus, it tells you where to expect volume to move pretty smoothly, in other words, through this low volume region, and where to expect congestion, A, here, and B, when you're running into all this sort of stuff here. That's what it's there for. It's a hugely important indicator. Let's just go back onto Tesla, and I'll hop onto Apple. on TradeStation. Where were we there? Yep, that's it. There we go. How's this move developing? Oh, very nice. Lovely, lovely. We're down at 14 now. How nice. Nice move. There we go. Let's pop the 1 minute. There we go. Nice little price waterfall. Generally widening spreads, rising volume. Very nice. Thank you very much. On we go. Not particularly scary. You know, nice, decent amount of money being made there. What's to stress about? What's to worry about? Nice. Very nice. Lovely. Look at the trend monitor. Yes, in congestion, it went into this darker color, but it's come out the other side. And the trend monitor was developed for one reason. And if you use it multiple time frames like that, it is so, so powerful. The reason we developed it for one reason and one reason only, and it's this: to help you stay in a trade once you're in a strong position like this and not be shaken out by these little, you know, the little rallies that come in. You think, oh, I've made some nice money. Oh no, it's going down again. Oh, I better close out. If you've closed out here, you are seriously regretting trading out, closing out by the time it's got to here. Trust me. Trading is not easy. It is difficult. And it's the emotional aspect which is the hardest to conquer. And the one thing that is the most difficult to overcome is this business of holding a trade once you're in a good position. Once you've got profit in a position, your knee-jerk reaction is to close out. As soon as you get one of these guys coming in, you're going to go, I'm closing out, take my profit, and I'm off to the hills to bank it. Fine. The problem with that is that you will bank a lot of small losses, and you will bank fewer smaller wins. And if you're only banking small wins all the time, your trading account will slide backwards. It's never going to go forwards, because the mathematics of trading, if you take 10 trades, you can still make money if you have 7 losers and 3 winners. But the 3 winners have got to be decent sized winners, as opposed to the 7 losers, which have got to be small. And that's the mathematics of trading. It's just the way it works. There's no way around it. So it's not a 50-50 game. You can, as I say, you can be 70-30, you can even get away with 80-20, as long as you have the ability to hold those wins. And it's what's so important about when the trading days come along, when they are really moving fast. And I think I mentioned it last week or the week before. We've spoken to a lot of traders over the years, particularly pit traders. And the one thing the universal thing they will tell you is that when they go to work, of the 320 odd days or 300 days, whatever they're trading, probably of those, a handful, 10, 15, 20 will be their big money days. That is when they will absolutely load and go up heavy, because the rest of it is noise. It's as simple as that. They win some days, they lose some days, they're up and they're down. But when those big moves come along, those are the days when you really have to fill up and you know, make money as much as you can when the market is moving fast. And it's, you know, that is a truism, whether you're a pit trader or whether you're an electronic trader, as we are. Let me just pull up TradeStation very quickly while I'm here, and I promise to show you Apple, because otherwise Anna will tell me off. There we are. Now, what's interesting about Apple, and again, it's one that we've had our eye on for a long time, particularly over the last few weeks, because again, as I mentioned before on Tesla, just pull that up a little bit if I can. You see here the volume point of control is there under this line here, and look at the strength of support and resistance levels that were developed around that region. Now, once the market breaks away from that, boy, oh boy, protection in place. There's a ton of it there. So it just gives you that extra confidence. Now, what's interesting also in this particular case, we saw, you know, big increase in volume as the market broke away, which is a classic sign of this is a genuine move. But what's also interesting about, let me just pull that down again. There we go. What's also interesting about Apple, if you eyeball it right now, just look at the blocks of volume, just the dramatic increase in volume that is going around over the last 7 or 8, 10 days, what have you. You know, these are huge amounts of volume being driven in there. And you would analyze this further by going obviously down to the week and perhaps to the month to get an idea of whether this is actually getting to a topping out phase where potentially there's an opportunity to short it. And if you want to short stocks, I know a lot of traders avoid shorting stocks, but it isn't that complicated, because what your broker does for you is actually borrow the stock from someone who holds that stock, and you are then able to short it, bearing in mind that if you are then shorting that stock, you are responsible for any dividends that are due in that particular period. So, I caveat it with that caution. However, there are much easier ways, and obviously the options market is a much more straightforward way of trading short. And but it's still curious in the stock world that the stock market still has this heavily bullish bias to it. 99% of people who go to the stock market are looking to buy stocks. They're investors. They're looking for stocks to go up. They want everything to go up, 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 up. Usual to find people who are looking at it with the inverse relationship. But I can assure you, making money at the short side is actually a darn sight easier than making money to the long side, for one simple reason, is that markets fall a hell of a lot quicker than they rise. And that's true whatever you're looking at. There are reasons for it. I won't go into it now. Anyway, I just wanted to show you Apple because it's getting to an interesting point. It's getting to a point, particularly, you probably can't see it very clearly on here, but the price spreads are starting to narrow. We've still got a lot of volume going in, and you've really only got to say, compare it with some of these other days over here. There's a lot of volume being driven in there. So, certainly one to keep an eye on. Just while I'm here, just want to show you a couple of other things. Where are we? Let's go to the hot list. Here we are. Let's go to the hot list. Sorry. One of the issues which we are obviously going to try and cover in the program is to do with stocks, is the sheer volume of data that you are trying to deal with, you're trying to massage, you're trying to interpret, you are trying to discover opportunities, and what am I going to trade, and et cetera, et cetera. So one of the important aspects of it is to have tools that can actually deliver that information quickly for you. Now, TradeStation is a great platform because it has 3 different variants. It's got, where are we? Let's go to here. I think it's on the stocks one. It has radar screen, which is this one, which is very much intraday. So this is telling you, for example, on Microsoft up here, 6 bars ago, we had a volatility trigger on the 3-minute candle. This one down here. So you can see we've got a volatility candle here. Now that may or may not be significant for you, but nevertheless, it just gives you a very rapid way of, and I've only got a handful of stocks here, but it gives you a very rapid way of seeing what's going on. We've got one there, we've got volatility here 4 bars ago, and you can go through these very quickly, scanning on, and just picking up these opportunities as they arrive and deciding whether you're going to do anything with them or not. It's Honeywell, so have a quick look at Honeywell. We had a volatility trigger there on 3 minutes, down here somewhere, there we go, that was a volatility trigger. Quite interesting because that was a breakaway from, let's pop that up full size, there we go. Another breakaway from a congestion phase. Again, an immensely powerful ceiling, what was a resistance ceiling at that point, has been breached. Massive volume coming in here at the open, you can see it there, into an extended congestion phase, patience, then we get the breakaway on volatility. The volume here is important, but it's distorted obviously by what's going on over here. You could expand that out and take it all the way out, and just if I do that right the way out, makes it a little bit clearer. So it's all about, let's just put that back, sorry, going the wrong way. It's all about the tools to rank, sort, and identify opportunities. This is very much intraday. This is radar screen, but there are 2 others. There's the hot list here. You can see up here, I've actually clicked this onto dollar gainers on the day. You can click through these. This one, for example, what have we got here? We've got a volatility trigger on this one. We've got a lot of volume coming in. We've got a volatility trigger on the day. It shot up, could be earnings related, could be anything you like. Don't really care what it is. Obviously, we're going to investigate it. I've also got the alerts has come on here. You can have alerts on all these indicators, any which way you care to choose. But obviously on the daily chart, we've got a volatility trigger. So, that might be one. You might look at that and think, do you know what? This looks like a shorting opportunity. We might see congestion. We might see a full-blown reversal, depending on what the news was being based on. Let's have a look at some of these others. And obviously it's giving you percentage on the daily. This is another one. Another with a volatility, gap up, away from congestion zone, gaps up, big gap here. Remember that gaps get closed. So if gaps get closed, it might be an idea to look at that as a potential short, coming right the way back down here again. I'm not suggesting it will, but certainly one that might be on your radar for consideration in the future. So you've got the hot list here with all the opportunities, which is very much a daily thing. You're looking at this for scanning for opportunities for tomorrow. You can choose this. Where am I? What are the gains over the last 10 days? All of these losers. Which stocks are approaching 52-week highs, the 52-week lows, or any gap downs, gap ups, all this sort of thing. Volatility lists, volume lists as well. You can sort on volume. I don't want to see small stocks. I want to see mid cap and large, etc., etc., etc. Finally, over onto this one. This is a different approach. Again, this is Market Scanner, and you can set up your own scanner on here. I've just got this set up to very, very simple to show me a particular size of stock and the RSI. I want to see an RSI above 50, so I can just whiz through this lot and it'll pull it up down here, and I can just have a quick look at the chart. Anna and I have, over the years, we have the ability to actually pick out. We're constantly looking for patterns, particularly when you're looking at daily charts. You're looking at congestion patterns. You're looking for a source of patterns where a stock's being sold off heavily and is now forming a saucer at the bottom and is starting to develop a move to the upside. Those two in particular. Obviously, you're looking at tops as well. Anna's talked about topping out volume. You're looking at rounded tops. You're looking for distribution at the top, possible reversals, all those sorts of things. But if you do it manually, I can assure you can do it by eye. We used to do it by eye, and we go through maybe 3,000, 4,000, 5,000 stocks a night. It would take us maybe a couple of hours, but you're literally going click, 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 and you're going through the chart on the daily time frame, bang, 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 and the ones you're interested in jump off the page, I can assure you. But having tools like this are immensely powerful and all part of the armory of trading. Just back to Tesla, there we are. I had the little rally there. We've gone into darker red again, but this is still holding bright red, so we're still in bearish country. And down here, yeah, no change whatsoever. And that's where we are with Tesla right now. So certainly a nice little trade there that came in real time. Just checking over on the other side, seeing what we've got in trading view. The yen is, I'll just pull this over very quickly before we wrap up. Oopsie daisy. There we go. This is the pound. These are basically the indices on 5 minutes, so just gives an intraday view. But the two I'm interested in, obviously the yen has been selling off. A little bit of a rally recently, gone into congestion, gone back into shell. This is the dollar. That's been primarily weakening, has been fairly bullish of late, weakening a little bit intraday. It's quiet at the moment. Everything's sort of calming down, and we will see what develops Friday. And then into next week, which, as Anna said, will be pretty much the sort of last week when the markets will be active. That's it. I'm going to wrap up. I've gone way over time. Sorry about that. Let's just pop this up full size. You can find all the indicators over at quantumtrading.com, MT45, NinjaTrader 78, TradingView and TradeStation. We are working on NinjaTrader at the moment. We are working on Market Analyzer because we want to bring the indicators over to create the same opportunities that I showed you on TradeStation to be available within Market Analyzer, because NinjaTrader is the one we're going to really focus on in terms of the stock trading program. So the development guys are working on that full bore at the moment. And remember, if you have the full package of indicators, then you will get anything we develop in the future free of charge. It's just the way we've always worked and have done for the last 10, 11, 12 years. So whatever you buy from us, if you invest in the full package, you get everything free of charge in the future. And in addition to that, if you've bought indicators in the past from us, whether it's one or two, you always get a full credit if you want to upgrade, if you're upgrading to a bundle, if you're upgrading to a full package, if you're upgrading to the education program, the Forex education program, and also the stock trading program, you will always get a credit for whatever it is you spend. We only charge a one-off payment for any indicator. There's nothing else to pay. You get 24/7 support and it's literally 365 days of the year. If you send us an email on Christmas Day, we will actually respond. Might not be in the same time scale, but we will actually respond, believe it or not. That's how we work and have always worked. Support is the top of our list, as well as creating great indicators. Finally, just to, where are we? There we are. That's the Forex education program. With the funded program alongside it. It's a complete program. And what's curious is we have a lot of stock traders on this program now, because over the last year, 18 months, 2 years, they have suddenly come to appreciate and realize that the Forex market sits at the center of everything. And the reason for that is very simple to understand, because if the market is moving from risk on to risk off, then assets have to be bought and sold. And if you're buying and selling assets, you're transferring into cash and back out again. And there's only one channel that goes through, and it's called the currency markets. That's why Forex sits at the heart of everything, and it's really only something that people have come to appreciate, but we're seeing a lot of it now with stock traders joining the program. We bolted in the funded program on top of it. You trade our money. It's not your money, it's our money. The reason we put it there was twofold. First of all, to give our students the opportunity to trade much larger sums of money, to get a feel for trading much bigger accounts, and secondly, to actually put that knowledge they've gained and garnered in the program to good use and actually benefit and profit from it accordingly. You start down here. Yes, there's a one-off entry fee, but that's it. You don't pay anything else. You can't lose your money because it's ours. Yes, there are risk and money management rules. You start at one of these levels. You decide where you want to start. It's up to you. And this is trading spot Forex to start with. But as you move up to the next level, which is portfolio manager level up here, you can trade these indices and gold as well. You start at this level. If you start at 15,000, we then multiply it by 4 as you get up to the next level. So you would give you 60,000 to trade with, and thereafter we double it, 122.40 right the way through up to the 2 million level. And you earn as you go, you profit. We kick back profits to you on a 50% return on portfolio manager level, and 60% when you get up to the 1 and 2 million levels on the account. Finally, Anna's site has floated over there for some reason. There we go. I'll just pull that over. That's Anna's site, annacouling.com. So you'll find all the analysis there, videos, what have you, recordings of these webinars, all the books up on Amazon. I have to say, sell extremely well, both in Kindle and in paperback format. So if you have them, thank you for purchasing them. We are much appreciative of that. And there will be other books joining them in the fullness of time. Don't think there are any questions. No, we're okay. Thank you very much indeed for coming along today. Hope you've enjoyed it. Hope you found it useful. A little bit of fun as well. Enjoy the rest of the trading day and the rest of the trading week. We will be back next week for our last session for 2021, which is a frightening thought, but there we are, not us. Well, maybe it is us. Being on a webinar is a frightening thought, I don't know. But the end of the year is a frightening thought, and into 2022, whatever that may bring. So we hope you stay safe, keep well, and we will see you again soon. And thank you very much for joining us today, and bye for now.